Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The 2024 financial year proved a good one for superannuation funds, with the median growth fund, which has between 61 and 80% in growth assets, returning 9.1%. That's about the same as the previous year and well above the target for most super funds. It's the 13th positive return in 15 years, but can it continue? To help me mull over that question, I welcome to the show Chant Senior Investment Research Manager, Mano Mohankumar. Mano, welcome to Fear and Greed.
Hi, Sean. How are you? Thanks for having me on.
Not at all. The results last year, 9.1% for the median growth fund, followed about the same, a little bit higher, 9.2, I think, for the previous year. Was it a surprise that they did so well?
Yes, it definitely was a surprise. It was on the back of that previous strong year, and it was achieved despite the uncertain economic and geopolitical backdrop.
So why did they make it? Why do you think they did so well? What was it that caused those returns?
On average, growth options have about 55% invested in listed shares, and listed shares had a particularly strong year. In particular, international shares, which returned about 22%. And that was really boosted by the tech sector, which performed incredibly well. And Australian shares, while not reaching the same heights, also returned a healthy 12%.
Okay. And so, I mean, if you had NVIDIA, for example, stock that did incredibly well, and I think there was some press articles about one of the bigger super funds saying they sort of sold out of NVIDIA, you were kind of on the wrong side of the coin there, because stocks like NVIDIA and that really drove some of these returns. Is that right, Mano?
Yeah, that's exactly right. If you think about the international shares exposure, that benchmark that the portfolios are measured against, have about 70% to the US, and a big chunk of that is those big tech stocks, as you know. So that's exactly right.
One of the trends, at least at first glance, but tell me if I'm wrong, is the fact that retail funds did fairly well versus industry funds. Now, for many years, and we've seen the ads for it, we've seen industry funds say that post fees, they actually do better. But in terms of your numbers, Chant West's numbers, firstly, are fees included, but generally it looks like retail funds did do a bit better this time around.
Our returns, Sean, are net of investment fees and tax. And look, over the last 12 months, if you look at the top 10, it is actually quite a mix between not-for-profit funds and retail. It all really came down to how much you had invested in shares, really. That was the main driver. And obviously, within shares, particularly if you had more in international, and did you have a high allocation to the tech sector, that was a really important driver. And, if you also had less in unlisted office property, yeah, you definitely would have benefited from that over the last 12 months. But then obviously it's a different story when you look at our top 10 over the 10-year period. That's completely dominated by the not-for-profit sector.
Is there any reason for that? Is it a fees story or is it an investment story?
No, it's really more an investment story. So you think about, on average, the not-for-profit funds have higher allocations to unlisted assets, while the for-profit segment, on average, have a higher allocation to listed shares and less in the unlisted assets. But as you can see, even over the last year, there are quite a few industry funds in there too, like including Mine Super, Brighter Super, Australian Retirement Trust, and Aware Super.
Yeah. Okay. So you're talking about unlisted funds there, which brings me to the point, we always talk about listed equities. Much easier to understand listed equities because you can go to Wall Street or the ASX and you can see what they're worth and off you go. Increasingly, we're hearing about unlisted assets. And in the last year or so, so unlisted property, for example, just explain what it is. And it hasn't had a good run, has it?
No, it's had a really difficult kind of 18 months. So really, with unlisted asset classes such as unlisted property, unlisted infrastructure, and private equity, they're not marked to market, as in they're not valued daily. So there is typically a lag in the valuations. And what we've seen with unlisted property in particular, both unlisted property, unlisted infrastructure, are sensitive to interest rate rises. And in the case of unlisted property, it's taken a major hit because of the trend towards working from home, which has been in place for a while, but it's probably stickier than what a lot of people expected. So that's been a significant driver of the negative return for unlisted property over the last 12 months. And in fact, it was the only asset class that finished the year in negative territory.
Stay with me, Mano. We'll be back in a minute. I'm speaking to Mano Mohankumar from Chant West. And what about, you mentioned private equity. So investing in private equity, which is very much an institutional investment, because it's very hard for mums and dads to invest in private equity directly, at least. What sort of returns were they providing?
Yeah, so early days in us collecting those final numbers, but we're estimating both private equity and unlisted infrastructure on average finish in that 5% to 7% range. So modest returns compared to listed equities, but both those asset classes have delivered tremendous results to super fund portfolios for a number of years. So private equity net of fees has probably returned over the last decade close to 13% on average, and infrastructure over the last 10 years probably about 10.5 to 11% per annum. So they play really important roles within a long-term portfolio, and super is a long-term investment.
Okay. What about some of the real assets? So when we talk about real assets, and I'm talking about listed real assets. So that's sort of the property groups, infrastructure is another real asset. How'd they perform?
Yeah, so international listed infrastructure was 4.5%. International listed property, 2.6%. So the super funds on average have a very low allocation to those asset classes combined. So on average, it's about, and a typical growth option has about 2% allocated.
So, I mean, we're going through all the asset classes here, so we better remember the defensive things like cash, bonds, local and international bonds. How'd they perform over the last 12 months or so?
Yeah, so Sean, we're finally getting some meaningful returns from cash, aren't we?
It's been a while.
So cash finished the year around 4.5%, and bonds, as you know, previous years, more of a drag. This year they are in positive territory. So Aussie bonds finished the year 3.7% up, international bonds 2.7% up.
Okay, so let's put all this together. Can it happen again is the big question. And I mean, I suppose this comes down to the fundamental idea of what superannuation investing is all about. We've had 2 great years. The year before, I might be wrong here, Mano, but I think it was the negative return, possibly the 2022 financial year.
Yeah, that's exactly right, Sean. Negative 3.3 was the number.
Right.
So that was during FY 2022, and that was during a period of, surging inflation and central banks hiking interest rates. So we really sort of 2 years ago started FY 23 in the middle of a lot of uncertainty. So really the aggregate return over the last 2 years of about 19%. It's quite astonishing given the backdrop.
So can it happen again, Mano? And I have to add to all our listeners, we're not an investment podcast, so you've got to go and get your own. Well, we always recommend you get your own financial advice if you are investing. Keeping that in mind, though, Mano, can it happen again? Can super make a 9% return again?
Oh, look, Sean, I've been wrong each of the last 2 years. Look, there is some uncertainty. As you know, inflation remains stickier than expected. There are some geopolitical risks that remain. But July is off to an absolute flyer with both Aussie and international shares up 3.5%. Look, in terms of other positive news, the US Federal Reserve seems to have gotten a little bit more comfort in recent days about inflation moving back to targets. So it's really that balance, isn't it? Bringing inflation back towards targets, but at the same time ensuring a soft landing.
Yeah, I mean, let's hope so. I suppose the point, though, with super is that we're not investing for the next 12 months or 5 years. Most of us are investing for decades. And so kind of it is the long-term returns that we should be worried about, Mano.
No, that's exactly right. And if you think about the last 5 financial years, that really highlights the importance of, maintaining that long-term focus. If you think back to early 2020, where you had the COVID-induced market crisis, where in the space of 2 months, super funds lost 12%, but then we had incredibly sharp rebound. So the last 5 years, the returns have been negative 0.6, positive 18, negative 3.3, positive 9.2, and positive 9.1.
That's pretty extraordinary. Mano, thank you for talking to Fear and Greed.
My pleasure, Sean. Thanks for having me on.
That was Mano Mohankumar, Chant West Senior Investment Research Manager. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.